What are the implications of $4.2 trillion balance sheet and the fact that they say they're just going to keep rolling it over? John Hilsenrath?
Well, I mean, that's a continued stimulus on the economy, and it could cost the Fed a fair amount of money when they do start rolling it off the balance sheet. They're not going to touch that, at least for another year, probably.
Why not?
Well, do they have to roll it off?
If everything is so strong and we need to see a 25 basis points move in the Fed rate, why in the world would they not start market operations?
Can I throw out, since we're talking about history, I want to throw out a little bit more history for everyone, but I want to go way back. I want to go back half a century.
Oh, please.
You know that after the Great Depression,
You've got to be kidding, John.
The three-month interest rate did not get over 1% until the 1950s. Financial crises they have very long-standing impacts on the economy and on interest rates. You can complain all you want about the Fed, but interest rates tend to stay very low.
But John, I'm not complaining about the Fed at all, John. I'm asking
Lou
a simple
thinks they did the right thing. Lou thinks they did absolutely the right thing.
If the market is so strong that they require a 25 basis point move, why in the world aren't they doing something with their portfolio? Why aren't they doing something with bank reserves?
Lou, can I jump in and help John here, because I think it's an important issue. It goes back to the U6 unemployment number.
Well, thank God you didn't go back to 1930. That's all I can say.
No, I'm going back to August. I'm going back to August of 2015.
Those who don't know history,
the 10.3% unemployment number has them scared.
All right, go ahead, Anthony.
John,
look.
No, I'm just saying that
this economy we're in today,
out here.
It's not.
Mark Zandi.
It's not the mid-1930s.
We want to get your take.
It's not the mid-1930s
on this balance sheet.
It's not. Yeah. Well, look, the balance sheet is working to keep long-term interest rates down. You know, they've taken bonds out of the marketplace, so all else being equal, that's going to keep long rates down, and that doesn't come back into those rates. Don't start to rise until they start letting that balance sheet normalize, meaning allowing the bonds on that to mature and for the mortgage securities to prepay. But they're only going to do that very, very slowly over time.
Yeah, they have
the first step is to start raising short rates, and then you allow the balance sheet to come down.
Yep. Guys, let me point your attention to this market.